Hello and welcome to our special presentation of the monetary policy that's going to be introduced in a few minutes. We're coming all the way live from Mint Street and we have an array of guests with us. We have Kaushik Das, the Chief Economist of Deutsche Bank, Lakshmi Iyer of Kotak AMC, Sivakumar of Axis AMC, and in a bit the Yes Bank economist Indranil Pan. I also have with me, of course, my colleague Ritu Singh, who is joining from the CNBC studios. Good morning to you, Ritu. Maybe you want to start by telling us the important takeaways from your poll.
Well, Lata, first on the rate and stance, at least our poll shows that, there's a unanimity, no change in the rates, no change in the stance to be retained at withdrawal of accommodation because durable liquidity is still comfortable. Another 50,000 crores will come into the system after that incremental CRR, the last tranche of it goes away. So no change there. On the inflation front, there is some expectation that it may be hiked marginally from 5.4% for the full year. But, half of our respondents do expect it to be retained. No change is expected on the GDP forecast, which is at 6.5% for the year. But I think the important talk is going to be around liquidity and what RBI really does, to ensure that there's no speculative outflow, so to speak, and what's happening on the rupee front. So whether they take any, direct action on the liquidity front or whether it is through some words, I think that is where the focus is really going to be.
Yes, you absolutely put your finger on it, Ritu. And let me toss that first question to Kaushik. Kaushik, ceteris paribus, other things being equal, the Reserve Bank will not move. But from August 10th to today, the US yields have moved up by almost 100 basis points. It was about 3.8 on the 10th of August. It's now closer to 4.8. So do you think there could be just anything to indicate discomfort?
Yeah, Lata, so there have been a lot of rate sell-offs in the US and oil prices were also higher like a few weeks back, above 90. So these are concerns from a medium-term point of view, what happens to the financial market. But as Ritu said, most of us are not expecting any rate action today. Stance also remains unchanged. The September inflation number should fall below 5.5% and core inflation should be below 5%. So RBI should take comfort from that. Inflation number could be revised up a bit from 5.4 just because of the near-term volatility. But the medium-term inflation forecast of April-June 5.2% and the January-March 25 of 4.4%, I think that remains unchanged. And that gives the direction to the market that RBI is not concerned about the medium-term inflation outlook despite the volatility. What is more important is on the liquidity front. I think RBI will sound hawkish and will try to keep the short-term rates above the repo rate. How do they do that? The problem is that after 2 weeks, you will have system liquidity or structural durable liquidity again back to 2.5–3 trillion surplus. And RBI will have to absorb that. Now, question is whether RBI does a CRR hike today, having reversed the ICRR. ICRR is getting reversed from tomorrow. So whether RBI replaces that with a CRR hike of 25–50 basis points to absorb certain amount of liquidity from the system, which looks, kind of not in sync in the sense that if they take out ICRR, should they hike CRR? One suggestion which I have made in my report is that can they do longer tenor VRRR at market-determined rate? At this point of time, the VRR happens as the repo rate or below the repo rate, slightly below the repo rate. The bids are rejected above the repo rate. If RBI allows the auctions to happen at a market-determined rate, maybe the banks will be more willing to pass the money with RBI at a higher rate at maybe 670, 675. That way, RBI can absorb more liquidity, and at the same time, the short-term rates could remain higher than the repo rate. So these are nuances which we'll look out for in the RBI policy.
All this need not come in the policy itself. It will be how they behave after the policy. Sivakumar, you have to trade. Okay, so short-term yields, money market as well as long-term. What is the range and what is the crucial thing that might disturb your range?
Absolutely. I think it's going to be very interesting because as your poll shows, and we are in agreement with that, we don't really expect much out of this policy. The risk is, of course, that RBI does something on liquidity as they did the last time. And I think if that happens, it will be a much stronger signal that they want rates aligned closer to the MSF rate than to the repo rate. And I think that will definitely create some amount of pain for the markets. But so the market expectation, or rather I should say the market fear is that the RBI might do something in terms of taking some liquidity measure. Other than that, I think the market will be neutral, and we don't therefore expect a huge change in market conditions post-policy. Completely agree to most of what Kaushik just said and your poll said, which is that expect more of the same, maybe a hawkish tone, but not much more than that.
And Lakshmi, what would you be watching out for, and especially on liquidity? Do you expect any, action, or like Lata said, perhaps what RBI does after the policy will be more important?
See, at this point in time, the liquidity in the banking system is negative to the tune of about 30,000 crores. And, and then with the government spending, etc., can this increase? That is one question, which looks like it is going to increase. But equally important is the fact that you have festivities coming up, and typically currency in circulation tends to go up at that time. And this also coincides with state elections. So I think there are a few of these factors. So I think it's important. And plus, of course, the RBI, doing some activity in the forex market. So the more you're, trying to come in, for, the dollars, you actually sucking out rupee liquidity. So I think all of that leads to the fact that if the system liquidity is enhancing, which is going to be more a function of end of this month, some action needs to be taken, but it's not necessary that it has to be announced in the policy today.
Parul, what is your sense?
On liquidity, we are not expecting RBI to take any action. We don't expect them to hike CRR or announce any OMO sales program. So we think they've taken system liquidity to a level where it is towards deficit, neutral to deficit, and they can use instruments, short-term instruments like FX swaps, which they're actively employing anyway, to manage short-term mismatches. So we don't expect anything more explicit to drain out liquidity. If it does come, it will be a negative surprise for the market.
Okay, Parul, what about any outlier? I mean, these are absolutely outlier fears I heard from people. The chances of maybe pushing Repo by 10 basis, or by doing something to CRR, something to show that we are worried about liquidity. Or do you think they will only stick to language?
So at this stage, I think they stick to language, but remain very vigilant. So what is happening today in the markets is there is more fear driven by what is happening globally. If US rates continue to ratchet higher, there will be an indirect pressure on Indian markets, and mainly through currency channels. So what we are doing in the market is really focusing on RBI's reaction function to the currency and whether rupee starts depreciating. The first pressure point will come there. Locally, from inflation perspective, how vegetable inflation has panned out, how core inflation is doing, we are comfortable. There is this greed factor also, where we see a lot of inflows lined up for next year. That's not translating into absolute yield levels, bond yields levels coming down, only because of the US yields, the way they are behaving. So market is stuck between greed and fear, and continue to look at RBI for guidance. I think they remain vigilant. No action required at this stage.
Okay. Well, Kaushik, again, outlier fears. That Reserve Bank has repeatedly said they are afraid, they are a little worried about unsecured loans. But unsecured loans are not falling. That is one of the rapidly growing areas, retail loans. Is there a likelihood of higher provisions or risk weights? Is that something that crossed your mind?
Lata, if you ask me as an outlier, I think, you should never rule out a possibility of a rate hike, because in this kind of a scenario where US is saying that rates can move significantly higher, to maintain the interest differential, although all the economists are saying no rate hike, just as a preemptive measure, they can, possibly do, 15, 25 basis points rate hike. And, it can be justified in the backdrop of what's happening. It's just that India's inflation trajectory will look good. So from that standpoint, they probably don't need to do anything. But if they're worried about the US rates trajectory and the pressure that is having on the currency side, external side, just for the real interest rate argument, they could, increase by 20, 25 basis points, which is an outlier. Again, that will come as a surprise. On liquidity, I guess, if you see Deputy Governor Patra's statement, he has been mentioning that liquidity, if it is surplus for a long time, feeding into inflation could be a issue. So they are definitely concerned with surplus liquidity and its potential impact on inflation, particularly when you're talking about credit growth remaining high. And, therefore, I would expect some action on liquidity. I think it will not be a case where there's no action from RBI in this policy. Some action will come in the form of either liquidity tightening. The basic idea would be to keep short-term rates higher, which kind of support the currency market to some extent. So I would expect definitely some action which might come as a surprise to the market.
Okay, Lakshmi, how important is the inflation forecast for FY25? There were people who were saying that if the Q4 second half, for instance, is way below 5, the market will look forward to a rate cut sooner rather than later. Are those numbers something you will watch? What is a good number for you?
So currently, Lata, markets will be more fixated on how the FY24 numbers pan out, because literally with so many things happening, especially globally on the US bond yield specifically, markets are kind of living by the day. FY25 definitely will be a case in point for reckoning, but the bigger driving factor, because also you need to remember that June 2024 is when the index inclusion also kicks in. So I think there is, clearly an antidote also available to cushion against, some sort of a dampening kind of a sentiment. So I think while that number will be definitely a watch out for what RBI gives, that's not going to be a material game changer at the current juncture, because markets are still fixated on how the US yields are going to behave. Crude, of course, is behaving less rude right now. And more importantly, is there going to be an immediate small near-term upward revision in the inflation guidance, keeping the FY 2024 inflation guidance intact?
But Mr. Shivakumar, would you say that you wouldn't worry about these FY25 numbers that will come out in the monetary policy report just yet? Because, I mean, that will give an indication of how far away we are from that rate cut.
From a medium-term repo rate perspective, definitely the market will take that as a strong signal, especially if they forecast inflation to be below 5%. Right? So obviously, that's going to be a strong signal from a repo rate perspective. But I think going back to your earlier questions that you guys are asking about, what is the outlier? I mean, remember that they still have the ability to raise the spread, right? So what they did during COVID was they raised the spread between the then prevailing reverse repo and the repo rate to kind of lower rates without officially cutting the repo rate. I think if you ask me what is the one shocker that they can do is easily to raise the MSF rate without touching the repo rate. So the risk, I think right now we have to watch for is that they take serious liquidity measures right now. I think the market's going to be reacting more to that than to, let's say, 1 year forward inflation.
Okay, it's almost 10 o'clock and we're still standing by to hear from the governor. But to sum all of the reactions from our guests, Lakshmi, Kaushik, Mr. Shivakumar, Parul, thank you all for your thoughts here. Largely, no change expected on the rates, no change expected on the stance, which is likely to be retained at withdrawal of accommodation. But we'll have to see how that hawkish commentary that is expected because of... Okay, we have the governor.
I would like to extend my season's greetings to everyone. This is the monetary policy statement for the month of October. And this is how it goes. Kautilya, in his Arthasastra more than 2000 decades ago, had said, stability enables a state not only to share its wealth equitably, but also augment it. These words are relevant even today. In fact, they have eternal validity. Macroeconomic stability and inclusive growth are the fundamental principles underlying a country's progress. The policy mix that we have pursued during the recent years of multiple and unparalleled shocks has fostered macroeconomic and financial stability. The external sector also remains eminently manageable. The twin balance sheet stress that was encountered a decade ago has now been replaced by a twin balance sheet advantage with healthier balance sheets of both banks and corporates. India is poised to become the new growth engine of the world. The need of the hour is to remain vigilant and not give room to complacency. Lessons from the past 1.5 decades and from living through the global financial crisis and the taper tantrum tell us that risks and vulnerabilities can grow even at good times. All stakeholders in the economy, be it lenders, corporates, businesses, both small and big, and even policymakers should continue to reinforce their buffers and fundamentals in the fast-changing world that we live in. So far as the Reserve Bank is concerned, we have identified high inflation as a major risk to macroeconomic stability and sustainable growth. Accordingly, our monetary policy remains resolutely focused on aligning inflation to the 4% target on a durable basis. Excuse me. Let me now turn to the decisions and deliberations of the Monetary Policy Committee, that is the MPC. The MPC met on 4th, 5th and 6th October 2023. After a detailed assessment of the evolving macroeconomic and financial developments and the outlook, it decided unanimously to keep the policy repo rate unchanged at 6.5%. Consequently, the standing deposit facility, that is SDF rate, and the bank rate remain at, consequently the standing deposit facility rate remains at 6.25%, and the marginal standing facility, that is MSF rate, and bank rate at 6.7%. The MPC also decided by a majority of 5 out of 6 members to remain focused on withdrawal of accommodation to ensure that inflation progressively aligns to the target while supporting growth. Now, you may say that this is a status quo policy. Yes, to the extent that the rate and the stance remained unchanged, it is a status quo policy. But there are many aspects of the statement and our policy which I am going to now spell out, which will reflect, which will reveal and give an idea about our approach, not only to monetary policy, but also to various aspects of monetary policy as we move forward during this, amidst this global challenges and headwinds. I shall now briefly set out the MPC's rationale for these decisions on the policy rate and the stance. Headline inflation has surged in July, driven by tomato and other vegetable prices. It corrected partly in August and is expected to see further easing in September on the back of moderation of these prices. A silver lining amidst all these is declining core inflation, that is CPI inflation excluding food and fuel. The overall inflation outlook, however, is clouded by uncertainties from the fall in Kharif sowing for certain key crops like pulses and oilseeds, lower reservoir levels, and volatile global food and energy prices. The MPC observed that the recurring incidence of large and overlapping food price shocks can impart generalization and persistence to headline inflation. Economic activity, on the other hand, has remained resilient. Taking into account the evolving inflation growth dynamics and the cumulative policy repo rate hike of 250 basis points, which is still working through the economy, the MPC decided to keep the policy repo rate unchanged at 6.5% in this meeting of the MPC. The transmission of the 250 basis points increase in the policy repo rate to bank lending and deposit rates is still incomplete, and hence the MPC decided to remain focused on withdrawal of accommodation. The MPC remains highly alert and prepared to undertake timely policy measures as may be necessary in order to align inflation to the target and anchor inflation expectations. I would now like to provide an assessment of the growth and inflation scenario to begin with global growth. Let me turn to a detailed assessment of the growth and inflation dynamics, starting with the external environment. As I just mentioned, the global economy is slowing under the impact of tight financial conditions, protracted geopolitical tensions, and increasing geoeconomic fragmentation. Global trade is contracting. Headline inflation is easing but rules above the target in major economies. While major central banks are signaling a peaking of their rate hike cycle, there are indications that the tight monetary policy stance could persist for longer than anticipated earlier. Sovereign bond yields have firmed up, the US dollar has appreciated, and global equity markets have corrected. Coming to domestic growth, in contrast to global trends, domestic economic activity exhibits resilience on the back of strong demand, that is, strong domestic demand. The momentum in agricultural activity in the second quarter of this financial year, that is 23-24, has been sustained, although the monsoon has been somewhat uneven. The acreage under Kharif crops as on September 29 was 0.2% above the last year's level. The industrial sector extended recovery in the second quarter. Manufacturing sector gained ground in July and August, supported by key sectors such as pharmaceuticals, basic metals, cement, motor vehicles, and food products and beverages. The Purchasing Managers Index, that is PMI for manufacturing, remained robust in September also. Services sector activity is maintaining buoyancy as indicated by healthy expansion in high-frequency indicators in August and September. PMI services, the data of which was just released yesterday, has exhibited strong expansion in September. Construction activity continues to be strong. Investment activity maintained its momentum with good support from government capex. Private sector capex is gaining ground as suggested by expansion in production and imports of capital goods and new projects sanctioned by the banks. Capacity utilization in the manufacturing sector on a seasonally adjusted basis continued to trend up, which augurs well for investment activity. The total flow of resources to the commercial sector from banks and other sources taken together at rupees 10.6 lakh crore during the current financial year so far is higher than that of last year. Merchandise exports and non-oil, non-gold imports, however, contracted, though at a moderated pace in August. Services exports expanded at a healthy pace. Now, what I have done is, I have given a lot of data points in the footnote of my statement, and those of you who are interested may refer to the statement. So whatever I am saying here is backed up by the data points which would justify the statements that I am making. So I would suggest that if there is interest, you may refer to the footnotes which are part of my statement. Now let me move on. On the demand side, steady expansion is seen in urban consumption, while rural demand is showing signs of revival. Looking ahead, domestic demand conditions are likely to benefit from sustained buoyancy in services, consumer and business optimism, government's continued thrust on capex, healthy balance sheets of banks and corporates, and supply chain normalization. Headwinds from geopolitical tensions and geoeconomic fragmentation, volatility in global financial markets, global economic slowdown, and uneven monsoon, however, pose risks to the outlook. Taking all these factors into consideration, real GDP growth for the current financial year, that is 2023-24, is projected at 6.5%, with Q2 at 6.5%, Q3 at 6%, and Q4 at 5.7%. The risks are evenly balanced. Real GDP growth for the first quarter of next financial year, that is 24-25, is projected at 6.6%. Now, I said that economic activity continues to be resilient, and this is precisely what I was hinting at this is precisely what I was referring to when I said that please have a look at the footnotes. The data points will justify that statement, why we are saying that economic activity continues to be resilient and why we are projecting the current year GDP growth to be 6.5%. I would now like to focus on inflation. The heightened inflation levels in July and August at 7.4% and 6.8% respectively were largely driven by food price pressures. Vegetables with a weight of around 6% in CPI basket contributed to about 1/3 of CPI headline inflation in July and to around 1/4 of overall inflation in the month of August. Sustained inflationary pressures in cereals, pulses and spices added to the overall food inflation. On the positive side, core inflation softened to 4.9% during July and August. It has eased by around 140 basis points, 140. It has eased by around, that is core inflation has eased by around 140 basis points from its recent peak in January 2023. Further disinflation of the core component is critical for price stability. As evident from our survey, there is further progress on anchoring of inflation expectations, which entered single-digit zone for the first time since COVID-19 pandemic. Now, this is a part of the surveys which we have done, so let me repeat this sentence for better clarity. As evident from our survey, there is further progress in anchoring of inflation expectations, which entered single-digit zone for the first time since COVID-19 pandemic, and the numbers are given in the footnote. While near-term inflation is expected to soften on the back of vegetable price correction, especially in tomatoes, and the reduction in LPG prices, the future trajectory will be conditioned by a number of factors. For Kharif crops, the area sown under pulses is below the level a year ago. Kharif onion production also needs to be watched closely. Demand-supply mismatches in spices are likely to keep these prices at elevated levels. The inflation trajectory will also be shaped by the El Nino conditions and global food and energy prices. In fact, global food and energy prices, if you see, over the last several months, they have been considerably volatile and they require careful monitoring, but that imparts further uncertainty to the inflation outlook. Taking into account all these factors, CPI inflation is projected at 5.4%. That is same as what we had projected earlier, and if there are questions, we will explain it during the press conference that follows usually my statement. Now, taking into account these factors, CPI inflation is projected at 5.4% for 23-24, with second quarter, that is Q2 at 6.4%, Q3 at 5.6%, and Q4 at 5.2%. The risks are evenly balanced. CPI inflation for the first quarter of next financial year, that is 24-25, is projected at 5.2%. Now, what do these inflation and growth conditions mean for monetary policy? Let me try and answer. Over the last 1.5 years, monetary policy actions broadly included compression of excess liquidity in the system, increase in policy repo rate by 250 basis points, and change in policy stance to withdrawal of accommodation to keep inflation expectations anchored and break the stickiness of core inflation. Complementing these measures were proactive supply-side interventions by the government to improve domestic availability of key food items and reduce input costs. Consequently, headline inflation moderated to 4.6% in the first quarter of the current financial year, that is from April to April, May and June of the current financial year 23-24, as compared to 7.3% in the first quarter of last year. So last year in the first quarter it was 7.3%. This year in the first quarter the headline inflation moderated to 4.6%. A significant easing of inflation pressures from its exceptionally high level in July and August is expected to materialize in September as the impact of fleeting food price shocks wane. Further, underlying inflation pressures are also moderating while the impact of past monetary policy actions is still unfolding. Even so, indications are that throughout much of the third quarter of the current financial year, food inflation pressures may not see much easing, or rather may not see sustained easing. External factors like energy prices and financial market conditions continue to be volatile. All these call for careful monitoring of the incoming data and the outlook. That is, we have to monitor not only the incoming data but also the build-up of the future, the outlook, to clearly delineate the durable components of price shocks from its transitory elements. Monetary policy has to be in absolute readiness to take appropriate and timely action to prevent any spillovers from food and fuel price shocks to underlying inflation trends and risks to anchoring of inflation expectations. These are non-negotiable necessities. I would now like to turn to liquidity and financial market conditions. As I have reiterated several times in my previous policy statements, excessive liquidity can pose risks to both price and financial stability. To ensure that liquidity conditions evolve in sync with the monetary policy stance, the Reserve Bank, as a temporary measure, had imposed an incremental cash reserve ratio, that is ICRR, of 10%, which impounded about rupees 1.1 lakh crore from the banking system. The ICRR was reviewed on September 8th and is being discontinued in a phased manner ending October 7th, that is tomorrow. Moderation in excess liquidity conditions as a result of the combined impact of ICRR and advance tax outflows in September has resulted in greater recourse to marginal standing facility, that is MSF, by the banks. Elevated levels of MSF borrowings amidst substantial funds parked under the standing deposit facility is symptomatic of skewed liquidity distribution in the banking system. So what's happening is that a set of banks, they are depositing in the SDF every day more than 1 lakh crores. Sometimes it exceeds 1.5 lakh crores. At the same time, there are other banks which are borrowing from the marginal standing facility of the Reserve Bank of an equivalent amount. So obviously the distribution of liquidity in the banking system is skewed. This got reflected in the firming up of weighted average call rate, that is WACR, which is the operating target of monetary policy. Despite such hardening at the short end of the term structure, the average term spread in G-Secs in the government securities market, that is 10-year minus 91-day T-bills, remained at around 40 basis points in August and September, suggesting stable financial conditions. In recent months, banks have preferred to place funds under the overnight SDF instead of offering them in the main 14-day variable rate reverse repo operations, that is VRRR operations. It is imperative that banks assess their actual liquidity requirements over the reserve maintenance cycle and bid accordingly in the auctions under the main 14-day VRR operations of the Reserve Bank. It is desirable that banks having surplus funds explore lending opportunities in the interbank call market rather than passively parking funds in the SDF at relatively less attractive rates. Greater volume of call money transactions would not only help in deepening the interbank money market, but also lower the recourse of deficit banks to the MSF. The release of the remaining impounded ICRR funds tomorrow, along with pickup in government spending, are expected to ease liquidity conditions. Festival time increase in currency demand may of course act as a counterbalancing factor. It's a turning pitch and we will play our shots very carefully. Going forward, while remaining nimble, we may have to consider OMO sales, that is open market sales of government securities, to manage liquidity consistent with the stance of monetary policy. The timing and quantum of such operations will depend on the evolving liquidity conditions. I would now like to touch upon financial stability. The Indian banking system continues to be resilient, backed by improved asset quality, stable credit growth, and robust earnings growth. The credit growth is broad-based and backed by strong fundamentals of the financial institutions. The financial indicators of the non-banking financial companies are also in line with that of the banking system as per the latest data available for June. Certain components of personal loans are, however, recording very high growth. These are being closely monitored by the Reserve Bank for any signs of incipient stress. Banks and NBFCs would be well advised to strengthen their internal surveillance mechanisms, address the buildup of risks, if any, and institute suitable safeguards in their own interest. The need of the hour is robust risk management and stronger underwriting standards. The global financial landscape is rapidly changing and potential stress may emerge from unanticipated corners. The Reserve Bank is closely monitoring the evolving situation and will act proactively to maintain financial stability. I would now like to touch upon the external sector. India's merchandise exports and imports have remained in contractionary zone so far during 23-24, although at a decelerated pace during July and August. Services exports grew at a healthy pace in the first quarter of this year and remained strong during July and August also, driven by software and business services. Inward remittances have risen by 5.8% year-on-year. The current account deficit for the first quarter of the current financial year 23-24 declined to 1.1% of GDP from a year ago. There was an accretion of $24.4 billion to foreign exchange reserves on balance of payments basis during the first quarter of this current financial year. On external financing, foreign portfolio investment, that is FPI flows, have seen a significant turnaround in 2023-24, with net FPI inflows at $20.3 billion up to September 23, up to September of this year, as against net outflow in the preceding 2 years. Net foreign direct investment, on the other hand, moderated to $5.8 billion in April to July from $17.3 billion a year ago. The inflows under external commercial borrowings, that is ECBs, witnessed a turnaround with net inflows of $4.5 billion during April-August this year, as against net outflows of $3.2 billion a year ago. The number and total amount of ECB agreements grew markedly during April to August this year, with about 60% of the total amount being raised for capital expenditure. External vulnerability indicators also indicate lower vulnerability in comparison with EME peers. India's foreign exchange reserves stood at 586.9 billion as on September 29 this year. We remain confident of meeting our external financing requirements comfortably. I shall now announce certain additional measures. The first one relates to prudential framework for income recognition, asset classification, and provisioning pertaining to advances, particularly in the context of projects under implementation. With a view to strengthen the extant regulatory framework governing project finance and to harmonize the instructions across all regulated entities, the existing prudential norms for projects under implementation have been reviewed. A comprehensive regulatory framework applicable for all regulated entities is now proposed to be issued. Detailed draft guidelines will be released for public comments. The next announcement relates to credit concentration norms, credit risk transfer, and this is in the context of the NBFCs. At present, under the large exposure framework, NBFCs in the upper layer are permitted to use credit risk mitigation instruments for reducing their exposures to a counterparty. With a view to harmonize the credit concentration norms among the NBFCs, it has been decided to also permit NBFCs in the middle and base layers to use the credit risk mitigation instruments for reducing their counterparty exposures under the credit concentration norms. The next announcement relates to gold loan bullet repayment scheme in respect of the urban cooperative banks, that is UCBs. It has been decided to increase the existing limit for gold loans under the bullet repayment scheme from rupees 2 lakh to rupees 4 lakh in respect of urban cooperative banks who have met the overall target and sub-targets under the priority sector lending as on 31st March 2023. This measure is in pursuance of our earlier announcement that suitable incentives shall be provided to the UCBs that have met the prescribed priority sector lending targets as on 31st March 2023. The next announcement relates to framework for recognition of self-regulatory organizations, that is SROs for regulated entities of the Reserve Bank. Self-regulatory organizations can play an important role in strengthening compliance culture among their members and also provide a consultative platform with the Reserve Bank for policy making. Therefore, it has been decided to issue a draft omnibus framework for recognizing the self-regulatory organizations, that is the SROs, for various categories of regulated entities of the Reserve Bank. And these draft guidelines will be issued for stakeholder comments. Additional sector-specific conditions may also be prescribed at the time of calling for applications. The next announcement is with regard to Payments Infrastructure Development Fund, that is PIDF, and we are extending this coverage of this scheme and including the Prime Minister's Vishwakarma scheme beneficiaries also. Since its launch in January 2021, the Payments Infrastructure Development Fund, that is the PIDF scheme, has enabled over 2.66 crore. I repeat, the PIDF scheme, since its launch in January 2021, has enabled over 2.66 crore new payment touch points across the country. It has been decided to extend the scheme by 2 years, that is up to December 31st, 2025. The coverage of the PIDF scheme is also being expanded, number one, to include the beneficiaries under the Prime Minister's Vishwakarma scheme, and number two, to deploy emerging modes of payment acceptance such as Soundbox and Aadhaar-enabled biometric payment acceptance devices. These measures will further accelerate the Reserve Bank's efforts to promote digital payments at the grassroots level. The next announcement relates to introduction of new channels for card-on-file tokenization, that is COFT. Given the growing acceptance and benefits of tokenization of card data, it is now proposed to introduce card-on-file tokenization creation facilities directly at the issue bank level. This measure will enhance convenience for cardholders to get tokens created and linked to their existing accounts with various e-commerce applications. And the final announcement is as follows, after which I will conclude. The last announcement relates to master direction on internal ombudsman mechanism in the regulated entities. You would have noticed that over the recent years, we have taken a number of measures to improve the system of customers' grievance redressal in the banks as well as in the NBFCs and other entities which are regulated by the Reserve Bank. Now, at present, we have also mandated, as you know, there is an integrated ombudsman scheme of the Reserve Bank. But before that, there is an internal ombudsman scheme in the regulated entities, be it NBFCs or banks. Now, at present, internal ombudsman framework in regulated entities comprises of separate guidelines for select scheduled commercial banks, non-bank issuers of prepaid instruments, NBFCs and all credit information companies, that is CICs. These guidelines have similar design features but vary in certain operational aspects. It has been decided to effect certain changes and also consolidate and harmonize the internal ombudsman guidelines into a single master direction. This will further strengthen the customer grievance redress system of the regulated entities. Now, I am referring here to the internal ombudsman scheme, which every bank, every NBFC, every regulated entity is expected to have, and they do have it. We are further fine-tuning that system so that customer grievance redress mechanism improves further. Let me now conclude. The Indian economy is forging ahead in a challenging global environment, drawing strength from its underlying macroeconomic fundamentals and buffers. While growth remains on track, the declining trend in inflation was interrupted in July and August due to price shocks in certain food items. Volatile energy and food prices in the wake of lingering geopolitical tensions and adverse weather conditions render uncertainty to the inflation outlook. We remain vigilant of the evolving inflation dynamics. I would like to emphatically reiterate, let me repeat, I would like to emphatically reiterate that our inflation target is 4% and not 2 to 6%. Our aim is to align inflation to the target on a durable basis while supporting growth. Our commitment to ensure financial stability reinforces our emphasis on price stability and anchoring of inflation expectations. This would keep inflation risk premium low and improve our competitiveness, productivity, and growth potential. As we continue our journey ahead, we take inspiration from Mahatma Gandhi's profound words, and I quote, "If we keep that as our goal, we shall never despond, we shall never weaken, and we shall ever go forward." Thank you. Namaskar.
Kind of policy, no surprises at all, no extra steps. But I think there was a warning. One warning came in the form of we may have to do OMO sales consistent with our monetary policy stance. So if there is excess liquidity than what they thought, that is if the call rate is declining, it's not standing at 6.5, then chances are they are going to come and sell bonds. And that's why I think You saw the 10-year bond yield go up. That was a big warning. And the other thing was, of course, the last statement, the very last sentence that the governor said, that our goal is 4%, not 2 to 6. I mean, he has said it before, but that as a parting shot can be considered a fairly important hawkish statement. Otherwise, there is really nothing that is changing the game plan for banks and for bond markets. The important point is they have not changed the CPI forecast for the current year. He's going to explain it in the press conference, but they had gone with 6.2 for the July, August, September quarter. Already in July and August, we have 7.4 and 6.8. So even assuming we get some 5.2, the overall forecast is still very high, but the RBI has only kept it at 6.4. That's important that they've not raised it too much. And for the full year, no change at all, which is a very benign, should be considered a soft, a dovish signal. But there is no dovishness in their language. They are not going to be happy with 5.2, which is the inflation forecast for Q1 of next year. Again, unchanged from the previous time. So all in all, I would say in terms of action, there is only that warning of we will sell bonds. When you sell bonds, you're tightening liquidity. That is the only warning that can be seen as hawkish. And then there was, of course, the language saying that we want to go back to 4. Otherwise, it looks like status quo. But let me get to the experts. Let me come to you. Upasana first. Upasana, what did you make of it?
Lata, you correctly pointed out, broadly, it is a very much in line with expectations policy. But I'd like to highlight two aspects here. One is, since August, we would see that RBI has been emphasizing on their shift in stance towards a tighter liquidity. And that's, again, something which they have reiterated this time as well, of course, through a reference of OMO sales if required. So they're going to be very micromanaging liquidity. I think they will be using all possible tools in the finely balanced way, but they would be micromanaging liquidity. And that is an effective way to go ahead, I believe, at this point in time when global environment is extremely volatile, despite maintaining a pause or a prolonged pause on the repo rate. So I think this is one big takeaway from today's policy. And yes, the other important point, like you already highlighted, was that there is no, the fight against inflation is not done with, and they're not getting away with just a 5% or a 5.5% inflation reading and draw comfort from that. Clearly, 4% is their target, and until that is not achieved on a consistent basis, they're not going to lower their guards. So I think these are two important takeaways from here. And on the inflation forecast, again, we are broadly in sync, but yes, I think for the second quarter, we are at 6.5% as against RBI 6.4%. And overall, we still see that 5.4% is achievable. So I think internally, we are different in quarterly profiles, but broadly 5.4 is where we are for the full year.
Okay, that's important. That could be taken as dovish. Rajiv, as a bond person, Rajiv Radhakrishnan is heads, the Chief Investment Officer at SBI Mutual Fund. Any movement in the yields? I can't see the yields now. I think it's 7.14. Was it unchanged, and near-term yields, swaps? How was the bond market taking this?
Yeah, I think very clearly the OMO announcement or the threat of OMO probably wasn't really factored in. So the immediate reaction has been yields have gone up by about 7-8 basis when I last saw, including swaps. But there were signals. In fact, when you look at the recent WSS, the RBI had anyway been doing small lot OMOs on the screen. So the number which I remember, the last was about net 5,000 crores they've already sold as per the data which is available till last week. But yeah, the threat of an OMO was probably not there. I think that's the reason why the market has taken a bit negatively today.
Okay, so you think that yields will now trade at a slightly higher range? Anything on the call market at all? You think it just hugs the 6.75 mark?
No, my sense is once the ICRR impounded liquidity comes back to the system, I would say that it goes back closer to where the policy repo rate is. So I think, and this is something that probably the RBI would want to minutely micromanage, because they would not want to have a situation where there is a significant deviation of the overnight or the WSCR below the policy repo rate. So I would say the incremental OMO sales would probably be tied alongside any significant deviation that one may see when liquidity returns. So in the near term, I do expect that the overnight rate should come back closer to the repo rate rather than staying at the upper end.
Okay. Well, I think we have the big banker with us, Mr. Sethi. Just waiting to hear what you have to say. There is some tinkering announced on project financing. Otherwise, does the life of a banker change at all? Any rules that you took away?
No, I think, Lata, you said right in the beginning of your opening remarks that nothing much changes. I think the policy announcements are in the expected lines. Primarily, I think the focus continues to be on inflation, and more emphatically stating that the target is 4%, not 2 to 6%. That leads to tighter liquidity management. Banks and the financial institution players have to definitely be ready for this tighter liquidity conditions for longer time. And so let's see how it plays out. I think, as pointed out, the ICRR ending tomorrow will infuse some liquidity. Around 50,000 crores is our estimate. And also some bit of government expenditure is adding to the liquidity. So immediately there will not be a great impact on tight liquidity, because it will be some easing there. But as Governor mentioned in his speech, this is a busy season. There will be festival demand, and the cash will be drawn from many of the bank accounts. So that also adds to a bit of strain on the liquidities in the overall system.
Okay. Any guess at all? I know your ALCO will have to meet. So just give me, with a banking sector perspective, do you see deposit rates inch up and therefore lending rates?
I don't think there will be any major impact on the rate movement, because though the governor pointed out that the 250 basis point increase on the policy rates is still, transmission is incomplete. It is for several reasons. One is, of course, everybody wants to try to project their margins. Margin compression is one of the important areas which all the lenders will be looking for. But as the demand for deposits grow, I think there will be some readjustment in the interest rates, if not across the board, in some of the maturities, which are more popular among the public.
Okay, Mr. Khajuria is also with us, Mr. Ashutosh Khajuria from Federal Bank. What did you make of, some of the, of course, no change in rates and stance and the threat of the OMO, and also some of the non-policy measures when it comes to project financing related rules being tinkered?
So first thing is, of course, the OMO sales certainly are more like, Damocles sword as far as the yields are concerned. This is the reason why there is some bearish sentiment mood in bonds market. That's also influenced by what's happening in US. So we have seen, the yields shooting up there in US, and that certainly has impacted our market as well. But as Ms. Shetty said, I think the liquidity coming back, that ICRR impounded part, would definitely be a relief. So from tomorrow, probably the liquidity would be back, but then there is a threat of, or rather, the risk of, the bonds being sold by RBI. On project finance, we'll wait for the details to come in and all. Probably we are gradually moving towards the global standards on recognition and all. So I would just say that right now. Let's see the details once the circular comes out.
Okay. Mr. Sethi, I wanted to ask you what you made of the governor's insistence. I mean, he said it in detail that they are very carefully monitoring data on personal loans. Therefore, any change in terms of how SBI or banks in general, because the governor is raising it and this is not the first time. Do you think the attitude to personal loans can go? They have not announced steps, but will you all put in more defenses, lower the pace of growth?
I think the governor probably meant unsecured personal loans. You know, most of the personal loans are given in the form of unsecured personal loans. So I think the system level unsecured personal loans is showing a significant rise. And as you know, many of the NBFCs and banks find it easier to dispense unsecured personal loans. But much of it is data-based, based on the past credit history and also the salary which comes into the account. As long as it is cash flow-based unsecured personal loans, I don't think there is any greater concern on that. But a significant rise on personal loans probably is bothering the RBI. So that is, I think, as you said, this is the second time governor mentioned in this MPC. While I keep saying, Lata, that personal loans differ from one lender to another, most of us in the public sector banking space are our personal loans, particularly on the unsecured personal loans, are very strongly backed by the salary flows. So I don't think we have any great concern in terms of the quality of these loans. But much of the system, particularly among the NBFCs and the personal loans, do not have that kind of backup of salary accounts. So maybe the concern is emanating from that. We'll have to see. Currently, of course, there has not been any significant rise in the capital allocation or risk weights of these personal loans announced in this MPC. But obviously, the concerns will be noted by many lenders.
Yeah, they've stopped short of trying to make it expensive for the banks, but let it off with a warning. Mr. Khajuria, just that last question to you. Will you all slow down unsecured personal loans or ask for, higher interest rate? Any way you will change your attitude to unsecured personal loans?
See, Lata, actually, for us, the base itself is very small. So I think we, at current level, we are hardly 2.5 to 3% of our total loan book. Now, personal loan, if you are just talking of unsecured part, but if you're talking of personal loans in the form of, say, auto loans or, housing loan and all, because personal loans are understood, in two different ways. One is the loans given to individuals. If that be the case, then, of course, housing loan would continue the way it has been doing. But if the concern of governor, which was more on the unsecured side, like your credit cards and your consumption loans and all, there, of course, with the so-called nudge, as well as the alerts raised by the regulator are suggesting that the growth in the system is quite steep, and therefore a need to rein in the rate of growth. So I think on that count, but if you're asking about our bank, we have a very small base, so may not be really impacting us a lot.
Well, perhaps the concern on personal loans, especially unsecured personal loans, is also stemming from the fact that a lot of new companies, fintechs, are aggressively expanding in the segment. But we'll come to that. Kaushik, a quick word from you as well, on your key takeaways. And the fact that the governor emphatically said the focus is on 4%, not 2 to 6% inflation. What does that mean in terms of how long we stay at 6.5%?
So yeah, Ritu, I said in the pre-policy show that there would be some surprise. Every policy you'll not have complete unchanged. So this has come as a surprise to the market because people were not expecting OMO sale. Rajiv mentioned that they were doing around 5,000 crore on the screen. But if they announce OMO, obviously bond markets have reacted negatively. Now the question is whether if liquidity absorption is the main issue, then could it have been done through a CRR hike or not? Now, RBI was reversing the ICRR, so doing CRR hike would have looked a little strange. So maybe because of that reason, they have, decided probably to go ahead with the OMO sale if required. There could be another consideration is that if you see the US 10-year treasury, it has moved up so much, whereas Indian 10-year bonds have not moved that much. And therefore, the spread between the two has kind of come up to 250 basis points or lower. Probably one reason, for doing OMO sale and not CRR is to make sure that the differential doesn't narrow even, more, because otherwise then, people will not see an incentive offshore investors to buy government bonds in India if they're getting such a high yield in US. Why would I invest in India when the, differential is so narrow? So one reason could be to drive it higher and at the same time take care of liquidity. On inflation, things are looking actually better. RBI has not changed their forecast either the full year or the first half of 24. They have kept it 5.2 if you see the forecast that they have given. And the thing is that they have mentioned that inflation expectations have fallen to single digit for the first time since COVID. So everything was going fine and was actually on the dovish side. And if you see the forecast that they've given for July, September, they've said that 6.4% is the average, going up from 6.2. If you back calculate, we have already got the July-August data. So September inflation actually should come below 5.2% to get that 6.4% average. So you are going to expect inflation to come quite significantly lower next week for September. So all this is fine, but the theme for globally as well as in India is higher for longer. So I would expect this to continue for another 6 months at least. And probably in April, RBI will consider cutting rates, because by that time, when you come to April, you'll see the July-September of next year inflation forecast, which RBI has not given out. Next policy they'll give. Inflation average will fall below 4% in that particular quarter, because this time it is going to be 6.4%. So I think April would be a good time when RBI will start considering cutting rates. But for the next 6 months, we're going to be high for longer and liquidity will remain tight. And RBI will ensure that the short-term rates do not fall below the repo rate of 650. And as far as the OMO quantum is concerned, if you were expecting, say, 50 basis point CRR hike, that would have been close to 1 trillion INR. So you could expect close to 1 trillion OMO over 3 months. So 35,000 crore per month over October, November, December.
Okay. Got that. Very quickly, Mr. Sethi, the governor has let off with a warning that banks are putting idle money in SDF, but they're not lending in the call market, with the result that simultaneously there are people borrowing from MSF and just dumping in SDF. You think this verbal warning is enough? Soumya was asking for actually extension of CCIL timing. Is that a disappointment that it didn't come?
Yeah, I think that would have really helped. In fact, we also have made representation to the RBI that some extended hours would be helpful. Hopefully, I think RBI may consider outside the policy announcements. But as far as SDF is concerned, also we must also remember that some of the funding in SDF is also to take care of 24/7 RTGS and NEFT requirements. But it is imperative that the banks should, with excess liquidity, should start lending in the MSF, which major banks like SBI normally do. That will definitely bring down the weighted average rates, the call money.
Okay. Thank you, sir. Thank you very much, Mr. Sethi. Ritu, over to you.
Well, Upasana, a quick word from you on the inflation projection. No major changes, slight tinkering for the second half of this year. But do you think any upside risks to these numbers that RBI has given? What is your own projection?
We are at 5.4%. So like I said, for the full year, there's not much of a deviation. Yes, within quarters, we are slightly different as compared to RBI. But I think broadly, there could be a 10 to 15 basis upside, if at all, to the overall headline number for the full year. So that's not a material uptrend or upside risk that we're talking about at this point in time. Like Kaushik mentioned, next year is going to be much more crucial, I think, from a policy stance point of view. And I think we are looking at 5.3% in the first quarter, which is RBI's compared to RBI's 5.2%. So broadly there again. Beyond that, there is a strong base effect, which will be helping inflation trend lower and fairly comfortable before the end of FY25, which again comes closer to 5%. So, I think not before mid next year is where we can expect a shift in the policy rate cutting cycle. I think that pivot probably will not happen before the middle of next year, not in April, not in June. Probably from August onwards, we can start expecting some changes that could come about in the policy rate cycle.
Okay. Well, I would request all of you to look at the MPR. The Monetary Policy Report has been published. Took me a while to download here in RBI. The connection is a little bad. Please go to page 6 and 7, and you have the inflation projection for next year. So there the CPI for Q4 24-25 is projected at 4.3%. That's the maximum confidence interval. Now, that's the only thing we have. Indicate that the inflation will average 4.5%. And the range is 3.8 to 5.2. Now, these are very important numbers. Kaushik, Upasana in particular, if you all are listening, they're expecting next year's average to be 4.5, very good. I mean, pretty close to 4. This year's average is 5.4. And the range is 3.8 to 5.2. So the maximum that inflation goes to is 5.2. And they end the year with 4.3. Now, Kaushik, does this advance your rate cut expectation or impact it in any way? Page 7 of MPR, please, everyone.
Yeah, I'm already, looking for a rate cut in April, so I don't want to advance it anymore. And I was in April when people were expecting 6 months back in October, December. So I've kept it constant. I told you that they had this forecast of 4.4% for January, March 25. They have actually reduced it by 10 basis points to 4.3. If you're saying it's 4.3, earlier it was 4.4. So if you look at the longer term forecast, and if you're saying the average for FY25 is 4.5, then the question boils down to how much real interest rate, positive real interest rate is enough. And if you think 100, 120 basis points is enough, then repo rate at 650 or, the short-term rates at 675, they can easily come down by 75, 100 basis points by the end of next year. And even then, you will have real interest rates positive by 100 basis points. Because if your policy rate comes down to 550, 575, and your inflation is at 4.5, you still have 100 basis points positive real rate. So that's why I think if inflation is on track, and we know that July, September next year, you'll have inflation below 4%. It'll be probably averaging 3.7 for that quarter. Certain months, you'll get inflation below 3% for the month of July, because we had 7.44 in this particular July. Next July, if you don't get that kind of shock in tomato prices, you'll see inflation falling below 3%. So I think April would be a good time to start cutting rates, and they could go as much as 75 to 100 basis points.
Okay. Okay, Kaushik, we have to wind up very quickly. The GDP figures for next year have been given, 6.5% as they said earlier, and the quarterly growth rates, the range is 6.3 to 6.6. So that's a fairly resilient outlook that they have. Same growth rate as this year in spite of all the global headwinds, tightening policies all over the world. In spite of it, the Reserve Bank has a fairly resilient outlook. Just one quick word, Upasana, first rate cut, please make it brief.
Not before August policy next year.
All right. I'll hand it over to you, Ritu. Thank you very much, everybody, Mr. Sethi, Mr. Khajuria, Rajiv Radhakrishnan, Upasana and Kaushik. Ritu, final comments?
Well, I think apart from the policy and liquidity related measures, the non-policy measures, I think that's what we'll now watch out for, whether it is the project financing rules, any further action from banks on the personal loan side. But on that note, we're going to wrap up this special discussion on the Reserve Bank of India's monetary policy. No change in the rates at 6.5%, no change in the stance, the warning of an OMO even as we approach this festive season, and that incremental CRR of 50,000 crores coming back in the system starting tomorrow. On that note, it's a wrap up from all of us. Goodbye and thanks for watching. Stay with CNBC-TV18 for more news and updates.